Hey everyone, welcome back to Actual Investing. I hope you're having a wonderful Tuesday or whatever day it is as you're watching this. It's Tuesday as I'm recording it. It's spring here. We've got some lovely weather, and spring brings new beginnings. So I wanted to show you the new and updated version of my portfolio. Now I want to preface this with saying that I don't typically like to make a lot of changes to my portfolio. I'm the type of person who believes in buying and holding for the long term. However, there's just been so much going on in the market, and I've been doing so much research lately that I felt I needed somewhat of a rebalance in my portfolio so that I can keep it steady for the long term. My last video, I had 25 stocks and I currently have 31. I've been adding money each month, so that's another reason that this has changed a bit. You'll see that I've added more stocks than I've sold. That's because I've been adding money to the portfolio. And it has been hitting new highs, which is great. I love to see new all-time highs, but it also is kind of bad because I really like to buy stocks on the cheap. So when the market's hitting all-time highs, I get kind of sad because I want the market to stay low so that I can keep accumulating at lower prices. So it's bittersweet, I'll say that. So let me just quickly go down the portfolio, and then I'll take you over to my spreadsheet and talk about why I made some of the decisions I made. So you'll notice that a few at the top are missing. One of my biggest positions, Synopsys, I sold. So a lot of the sells that I've made, you'll notice it was because of valuations. Now, this is maybe not the best thing to do. However, I noticed that a lot of the high-flying SaaS stocks were reaching very high valuations and valuations that they hadn't seen in quite a while. And I kind of sat down and reevaluated whether I was still comfortable investing in these companies at their current valuations. And I decided to sell a lot of my SaaS stocks. So Synopsys was one, Palantir, Cloudflare, and the Trade Desk and CrowdStrike, which I did replace CrowdStrike with Palo Alto Networks. So I'll talk about that in a bit. But yeah, you'll notice that part of the theme is that I'm selling highly valued stocks and buying what I believe are low or more inexpensive stocks. And that is definitely timing the market, which is not something I recommend, but it just happened to coincide with my portfolio rebalance. So it's not something that I'll be doing in the future, but it did kind of prompt me to take another closer look at some of these companies. Even companies that I really believe in, like Palantir and Synopsys, are wonderful companies. I just felt like the price was too extreme and I wanted to just lock in my gains. I had gains on all of those stocks, so I just wanted to lock in some gains and park them into some just more stable, solid companies, as you'll see as I go down this list. So Tesla and PayPal are still near the top. Tesla's been beaten down, so I've added to my Tesla position a bit. PayPal has just been kind of holding steady. NextEra Energy is a dividend champion in the utilities sector. They have the United States' biggest utility, which is Florida Power, and they also have a renewables arm. I actually looked at, there was a new, I don't want to call it an IPO, but a spinoff. General Electric spun off GEV, which is General Electric Vernova, I believe it's called, which is a renewables utility. And I kind of pitted NextEra against GEV, and I just didn't like what I saw with GEV. It was too not mature enough. NextEra was still more mature, had better margins. GE Vernova kind of promised all this margin expansion in wind, which I don't doubt. I'm sure that the margins on wind energy will improve, but it was just too speculative for me. I mean, this thing just started trading, and with such terrible margins, even though I had such a low valuation, I was happy to pay a bit higher valuation for NextEra. Xylem, I have added to my Xylem position. If you'll watch my most recent video, it's 5 on the 5th for April, 5 stocks to buy in April. Xylem was one of them. It's a water technology stock, and essentially they are involved in every aspect of water, from transport to purification, and I am just so bullish on the water thesis, and Xylem is the, in my opinion, safest way to play the water tech theme. So I, in fact, added to my Xylem position. Starbucks is still up there. I'm still quite bullish on Starbucks. The price of coffee is rising, which is not great for their business in the short term, but it's a company that's going to be around. I mean, nothing's going to happen to Starbucks. So in the long term, I'm quite bullish. Thermo Fisher has not changed. I still love Thermo Fisher as a company. They provide the picks and shovels to the life sciences industry, so drug discovery, that type of thing. I'm not a big biotech guy, so Thermo Fisher is my way to play the biotech industry without actually knowing anything about biotech, because they're kind of the one-stop shop for life sciences tools. Palo Alto, so that's a new addition. So Palo Alto is new because I sold CrowdStrike. So if you look at valuations, CrowdStrike on a price to annualized sales had twice the valuation that Palo Alto Networks had. And Palo Alto Networks recently had what I believe was an overreaction after their earnings report. So I swapped those two out. I'd been kind of looking to lock in some gains on CrowdStrike. I mean, if you have been following CrowdStrike, you know that stock has just been relentless. I made something like 150% on it. It was just crazy. So I decided to lock in some gains on that and move it over to Palo Alto so that I can still have cybersecurity exposure at a more reasonable valuation. And also, Palo Alto Networks, in my opinion, is a bit more of a jack of all trades, whereas CrowdStrike was kind of a master of one endpoint security. Palo Alto does endpoint as well as other aspects of cybersecurity. So to me, I was diversifying my cybersecurity exposure. Adobe still very bullish. I haven't added, but still up there. Snowflake I have added to my Snowflake position. They also had a recent earnings crash, which was nice because this was one of the high-flying SaaS stocks that that I considered selling, but big data just has such a massive market, and I think that everybody is going to use data in one way or another. Every business is going to, so I don't see demand slowing down in the long run, and Snowflake is finally hitting some somewhat reasonable valuation, so I decided to add a bit. UPS is a new one that I've added to my portfolio. So one thing you'll notice is that I've been adding a bit more of these value dividend stocks and selling some of the growth, maybe even unprofitable stocks. That might not be your cup of tea. Maybe you like growth stocks and you find value stocks to be too boring. That was always me too, as I've begun to accumulate a little bit bigger portfolio. Preserving wealth has been a bit more important to me. So I kind of took a look and said, well, are there some stocks that maybe are cheap right now that I know are going to be around for a while that have good financials that I can rely on? So I'll talk about the financials in a minute, but UPS was a new addition to the portfolio at a 4% weighting. I just kind of went all in on that. Not all in, but I just bought the whole position at once. They were down 7% in one day after pre-announcing their earnings. And I looked at the earnings report and I didn't see anything out of the ordinary. I don't know if the market was just expecting more, but I really liked that opportunity to buy. So I added UPS. S&P Global is another one that I added to my portfolio. This is a competitor to Moody's MCO, which is a Warren Buffett favorite. I added S&P Global because I like their financials a bit better than Moody's, and they have some decent growth despite being a dividend champion. STM is a semiconductor stock that I also talked about in my last video. If you haven't seen my last video, definitely check it out. I mean, every month I talk about 5 stocks that I like, and then you can maybe add them to a watch list, that kind of thing. But I ended up selling my ON semiconductor position and buying ST Microelectronics. They're very similar businesses. ON was a bit more of the high risk, high reward, and ST is more of the established leader that maybe has less upside, but also hopefully less downside. So I decided to make the switch, invest in the leader of ST Microelectronics, and it also gives me some global diversification. I've been buying some international stocks, as you'll see as I go on down the list, and ST Microelectronics operates out of Europe, so it was nice to have a European stock that I could add to the portfolio. Clean Harbors is nothing new. I had Clean Harbors previously. I love Clean Harbors. I'll probably never sell this stock. It's I labeled them pollution control, but essentially they are a waste management company that isn't in the industrial sector, but they also help with cleaning up our oceans. And I'm a bit of a tree hugger, if you haven't noticed from my videos, so that was something that I wanted to get behind. And as they had a reasonable valuation and good financials, I decided to go long, and I've been kind of just riding that wave ever since, no pun intended. Pfizer, still no change here. I did sell J&J, Johnson & Johnson, which is kind of crazy because I feel like Johnson & Johnson was just such a behemoth, and they spun off Kenvue. So you'll see farther down the list that I sold J&J and bought Kenvue. The reason I did that is because Pfizer is a drug maker, and J&J, after spinning off Kenvue, was also a drug maker. So I didn't want 2 drug makers. So I kept Pfizer, and I bought Kenvue, which is the consumer goods division of Johnson & Johnson. Think like Band-Aids and baby powder and that type of thing. Lotion and all that. Nintendo's a new ad. I've owned Nintendo in the past. I don't even remember why I sold it. I think it was something with it being an international stock. I was going to sell it and buy the actual Japanese shares on the Tokyo Exchange, but they have that rule where you have to buy in lots of 100, and that was just a lot of money for me at the time, so I just didn't want to get involved with that. I wanted to dollar cost average, and the ADR, which is NTDOY, is trading at like $13 a share, so super cheap, so I could get plenty of shares and still DCA. So Nintendo is a stock I'm bullish on. I kind of believe that they're like a better Disney. So Disney has their intellectual property, the mouse. Everybody recognizes the mouse. Nintendo has Mario, and everybody recognizes Mario. They have Pikachu. They have Link from Legend of Zelda. They have Kirby. I just feel like Nintendo has so much intellectual property that they're going to become like a Disney, where they can have parks and they can have movies. They're making that Super Mario Brothers movie. So I just feel like Nintendo is a great way to diversify out of the country. They're a Japanese company, and I just think they have so much going for them in their in their intellectual property. Man, I need to stop talking so fast. DigitalOcean is something I re-entered recently. It is a riskier stock, so I know that the theme has kind of been de-risking, but I did end up buying a little bit of DigitalOcean, only a 3% weighting in my portfolio. They're a pure play in cloud computing, and I'm really bullish on the cloud computing thesis, so I did want to make sure that I had some exposure to that. The biggest issue with DigitalOcean is going to be their debt. They do have a lot of debt, which they use to build this infrastructure of computers. However, I think they are profitable and they're going to be able to manage that debt, or at least that's my hope. LVMH, you may not have heard of LVMH, but you likely have heard of their brand. So LVMH stands for Louis Vuitton, Moet, Hennessy. So Louis Vuitton is obviously the luxury goods. They make clothes, handbags. It's a huge fashion house, probably one of the biggest fashion houses in the world. Moet is champagne and Hennessy is cognac. So this is a conglomerate of different luxury goods, ranging from spirits to clothing. They also recently purchased Tiffany & Co., some jewelry as well. Luxury goods tend to be resilient in terms of the consumer discretionary market, and LVMH is probably the biggest, I think it is the biggest luxury goods company in the world, so that was something I wanted exposure to. Their financials look good. I kind of pitted them against Kering, which is their rival. That one's Gucci, and their financials were just so much better than Kering, so I decided to go long LVMH to diversify into other countries and to get that high-quality luxury goods exposure. Abbott Labs is the next one, ticker ABT. They're a medical device company. They also make kind of like what Kenvue does, consumer staples. They make Pedialyte, that type of thing. So Abbott I added because they are a dividend champion. They've been increasing their dividends for, a super long time. I think it's been around 30 to 40 years. I'd have to double check that fact. They spun off AbbVie, which is another huge company. They're a drug maker. I decided to go along Abbott because, like I said, I already have a drug maker in Pfizer, and Abbott's shares took a hit after one of their competitors had a lawsuit issue. It didn't affect Abbott Labs at all, but Abbott Labs stock suffered, so I decided to go long. This was probably last month. Shoals I added to recently. Shoals is a solar hardware provider, and their stock has been hitting all-time lows. So that's unfortunate, but it's great for me because I just bought some more in the $10 range. I haven't seen this price since everything was falling back in, I think, 2022. So this was a great opportunity for me. Shoals is a high-risk stock, no doubt about it. They're a small company. They have an ongoing lawsuit with a French wire maker over some faulty wires. Shoals says that it was the wire maker's fault. The wire maker says, nope, our products are perfect. It was Shoals' fault. So that impacted their margins, and their growth is obviously stalling because the solar sector is stalling in general. However, Shoals caters to the commercial solar segment, so their revenue is a little bit more safe than the residential sector, which tends to have bigger swings. Kenvue, I talked about already a little bit. I bought that after selling J&J so I could get exposure to consumer goods. Salesforce is a new one. Salesforce, ticker CRM, is a stock I've sort of had my eye on forever and just finally went long as I started adding some money to the portfolio. I feel like they're one of the more reasonably valued SaaS stocks. And if you look at my spreadsheet, they're one of the highest scoring stocks on my spreadsheet, so not too much to say there. GitLab is another recent addition. I had been in and out of GitLab in the past after their valuation just kind of had a massive swing with all the AI hype. Shares have kind of come back down to earth in the $50 range, so I decided to go long again. GitLab, they're a software development platform. Rockwell Automation is not new. I've had Rockwell Automation. They develop devices, sensors for industrial automation. Allegro Microsystems, I'm back in Allegro Microsystems. This one is probably the oldest buy from this video since the last one. They make sensors and semiconductor chips for electric vehicles, robotics, and lots of different types of disruptive innovation themes. I did cover Allegro Microsystems in my self-driving cars video if you'd like to learn more about them. Unity Software has been a disappointment, but I'm still holding strong. Expedia is a new one that I got back in. If you've been around, you know that that's the highest scoring stock on my spreadsheet due to their low valuation, steady growth, and very high gross margins. And I like them better than Airbnb, but I still like the home rental niche. So that's why I have Expedia. They own Vrbo. So that is my sort of Airbnb sympathy play. Pure Storage is nothing new. Pure Storage has been on a tear. I didn't really sell or anything. They're still going strong. Consolidated Water is a new one, so that's another water stock. I haven't talked about them on this channel yet. They're my smallest stock. They're definitely a smaller player in the space. I typically don't invest in companies this small, but I decided to take a very small position at 1% and then doubled down at another 1%. Their stock has just been beaten down. They've been seeing some great growth, reasonable margins, good profitability. They do pay a dividend, so it's an interesting little blend of growth and value there. They operate a water utility for the Cayman Islands. They actually are the water provider for the Cayman Islands. Enphase is my residential solar play, as Shoals was my commercial solar play. Enphase is in a world of hurt right now financially, but I have no doubts that they're going to recover. They are the superior company, I believe, to competitors like SolarEdge that makes string inverters. Enphase makes microinverters, which aren't all daisy-chained, so you have a little bit more flexibility there. And Enphase does have better margins and historically has seen better growth, better performance. So Enphase I just liked more than SolarEdge. And Enphase, like I said, is in a world of hurt. Their share price has been doing okay after the crash. I mean, they tanked something like 70%. Just because solar demand has been drying up residentially across the world. I thought it was a U.S. issue. It proved to be around the globe, so even in Europe and other countries. But they are still expanding their product offerings. They're expanding into new countries like Australia. So I have no doubt that Enphase will weather the storm and will come back and be hopefully better than ever. Toast is a position that I just like Toast. I know that's a silly reason to be invested in a company, but I just really like their offerings. I think their valuation makes a lot of sense. They're one of the highest scoring stocks. Issue with Toast is their gross margins are very low, but they did finally breach the 20% mark, and they're slowly improving every quarter. So Toast gross margins, I think, will continue to improve as they milk that software platform a bit more. And finally, Energy Recovery, I talked about in my last video as well. They are a desalination company. And Energy Recovery essentially takes the energy that's lost in desalination and reuses it, saving companies money and helping to contribute to the supply of potable drinking water. So, oh my goodness, that was long, but that is my new updated portfolio, 31 stocks that I like. Some other stocks that I sold that I didn't talk about are going to be Teladoc, which I sold because they just had a terrible earnings report where they forecasted basically no growth for the next 3 years. I sold Bill, which is a software stock that I was beginning to question the moat of. I believe that it's going to have too much competition, and it was just a bit too risky for me. Intuitive Surgical just had a massive valuation. Wonderful, wonderful company, but something that I didn't want to continue to hold with those risks of their high valuation. And I believe that's it. Let me check my list, make sure I'm not missing anything. That is it. So next thing I'll do is talk about my spreadsheet and show you how these stocks and companies score. All right, and here we are at the other page of my spreadsheet. So this is new. I don't think anyone's really seen this before. I'm still kind of filling out some of these fields, but I wanted to show you this spreadsheet, which gives just a simple list of metrics for the stocks that I'm holding right now. So you can see kind of why I made some of these decisions. So let's just dive into it and talk about my new additions to the portfolio. So we'll start down here at the bottom because this is where most of the new additions are going to be. So Kenvue was a new addition. Things I liked about Kenvue, look at this strong gross margin of 56%. They are spending quite a bit on SG&A, but they have no R&D costs because their products are going to be the same every time they're made. Since they're a consumer goods company, they're not going to have to change things as much. So think about Band-Aids. Band-Aids have been the same forever. There's really not much research and development that goes into making a Band-Aid. The Band-Aid's not really going to change. Debt to equity here is close to my limit, quote unquote, of 80. I will still invest in companies with a debt to equity above 80, but I'll be a bit more cautious about it. So they are right below. So as you can see, nothing here is highlighted red, which means nothing breaks my quote unquote rules. They're really more like guidelines. And so that means this was a company that I liked. And look at that. At the time of investing, this doesn't update automatically, so I would have to update this manually. But at the time of investing, they had a dividend yield of about 4%. So I like to see that. It's not too high where I'm going to be worried about it being sustainable, but it's still going to give me a nice 4% return without doing anything. I own this stock in my Roth IRA, so it's going to be a tax-free dividend. I might do a video on the different types of accounts and how to get tax-free dividends, that kind of thing. So maybe that's a bit clickbait, but anyway, so there's my thesis on Kenvue. Consolidated Water, I talked about this very small market cap. That's below what I typically invest in, 400 million. But I just really saw a nice, compelling very small cap company, and I did want to kind of diversify into that. It's only 2% of my portfolio, so if they do go bust, I'm not in a world of hurt. They have these nice gross margins of 69%. Like to see that. And you know what? Actually, this is so funny. This actually did not get updated, so I'm sorry. So I will have to go back to quickly my other page. This will have the accurate margins. I was going to say that seemed very high. Consolidated gross margins are 34%, but what I like is that they have a reasonable valuation of 2.3 times annualized sales with almost triple-digit revenue growth. So sorry about that. Like I said, that spreadsheet needs to be updated. All right, let's go back to it. So let me just delete this out so I don't get confused by that confusion there. Okay. LVMH, like I said, wanted to diversify into Europe. They have nice 69% gross margins. Again, not spending too much on SG&A, not too much debt to equity. The valuation is a bit steep for a value stock at 5 times annualized sales, but they do have some decent growth to back it up, so I was comfortable paying 5 times annualized sales. Salesforce, speaking of sales, is a CRM platform that I talked about. They have these lovely gross margins right in line with what I want to see from a SaaS company. Probably on the low end, honestly. I mean, I would love to see more than that for a SaaS company, but for a company that's so big, I love that they're going to be a cash-generating machine at some point when they want to be. They actually just declared a dividend, so look at that. They have a 0.5% dividend yield. So that's a safe software stock that I felt comfortable investing in. S&P Global, we kind of talked about this already with them being a dividend champion. They also have these nice gross margins. UPS, and I probably should make this red. Let me go ahead and do that really quick. Their gross margins are just below what I like to invest in. 20% is usually my minimum. But again, like I said, these are guidelines and not hard and fast rules. So even though UPS has 1% lower gross margin than I look for, I felt I could look past that. Oh, and I gotta make this red too. The debt to equity is also quite high, because this is a bit of a capital-intensive business. However, look at their valuation, 1.5 times annualized sales, very cheap, and they're not spending too much, so a lot of that gross margin just goes straight into profits. They are a decently profitable company with a high dividend yield right now and a small track record of increasing that dividend, so I felt comfortable investing in UPS. Nintendo, I really have no complaints here. They have reasonable margins, reasonable valuation. It's just a reasonable stock. I kind of told you my thesis besides the financials already. And then the only other new ones I guess I would want to comment on are Abbott, which again has a very decent gross margin of 55%. They're a medical device company, so I like to see something around the 50% for medical device companies. Valuation is again kind of like LVMH at 5 times annualized sales. They pay a respectable dividend of about 2%, and they don't have too much debt to equity at 41%. ST Microelectronics was very similar to ON Semiconductor, and that was a really tough switch. I really kind of mulled over that a lot before making the switch, but STM was the leader, so I decided to swap, and actually they pay a little dividend where ON Semi does not, and that's only because they're more of an established company. So this is the metrics of the stocks I'm holding. You can see the times where I've broken my rule, where maybe certain companies like Snowflake and Unity spend a bit too much on R&D. They're spending over 50%, but I'm hoping that that will come down over time as their gross profits expand. And you can see that a lot of these companies actually have a bit more debt than I'd like to see, but some companies are very effective at using their debt. So Starbucks, we see they actually have more debt than they have equity. So normally that's a red flag, but Starbucks is so profitable that they're able to pay off this debt, and they're using that debt to grow because they're going to open more restaurants, more locations, which is going to help their revenue growth. So I have to kind of take this with a grain of salt. Again, NextEra Energy, very capital-intensive business. If this is a capital-intensive business, of course they're going to have debt. Are they going to be able to, A, be profitable enough to pay down that debt, and B, use that debt effectively? If that's the case, then I'm comfortable investing. Some of these are just right outside the border, like Pfizer, Unity, both at 84%. My warning begins at 80, so I'm willing to let that slide, kind of like how UPS had the gross margins of 19, where my cutoff's usually 20. I'm willing to let that kind of thing slide. I say this a lot, but everyone's investing journey is different, so I think it's good to have rules for your investments so that you don't go in and do anything silly, because emotions can really take over. You see a stock that's just taking off, and maybe you want to just invest in it quick before it gets away from you. I think it really helps to have guidelines so that before you do that, you can stop, plug it into your spreadsheet, see, okay, what do the financials actually look like of the stock before I get into it? Don't just jump into it because everybody else is, right? So anyway, much longer video than my usual videos. I hope you guys enjoyed. If you want to see more portfolio updates, let me know in the comments below. And then I'll get back to just covering new stocks in my next video. So if you have any stock recommendations of things that you want to see me cover, I already have a couple recommendations on deck. So thank you guys for that. I'll get to those shortly as well. But yeah, please leave them in the comments below. And thank you so much for sticking around and watching. I hope you have an awesome day.